Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Anand Shah, Head of PMS and AIF Investments at ICICI Prudential. And the conversation today is centered around what could be the key themes that could be a core driving part of maybe their portfolio and of the markets at large, which could help the satellite investing portions as well. Anand, I hope I got that correctly. But net, of course, great having you. But net, what we wanted to understand from you today was about investing in mega trends. And we've always tried to identify, or investors always try to identify mega trends that could last for multiple years, maybe not decades, but multiple years. And right now, at a point of time where over the last 1 decade, wherein cycles have become very, very short, do you reckon there is still opportunity to invest in mega trends?
Hi, very good morning and best wishes, and hope everything is safe, everybody's taking good care. I think coming to economy and markets, I think things are, part of the things are same from where they were, like banking, financial services, IT services, and actually strengthening further in this COVID period. Typically, it so happens that in every crisis, some of the stronger companies further emerge stronger. I think, but outside that, I think what I was discussing before also, manufacturing in India, I think that is something which has been lost. It's been a lost decade since a long time, and it's not been only for India, but a lot of economies have suffered because obviously there was overcapacity in manufacturing in China, and there was deflation within manufacturing, so you didn't have much of a profitability. But I think that's changing. That is something which we are watching out very closely. Do we see manufacturing coming back? We need jobs, and it's the right thing for us. I think the focus of government from the day one was Make in India and so on and so forth. So a lot of stuff happening on that front also. But I think a lot of forces are coming together, which can first start the manufacturing sector doing well, and then obviously post that would be the private sector capex. So I think these are the two elements which we are seeing differently from what we have seen in last couple of decades. It's been last we saw this manufacturing and capex cycle frittering out sometime between 2007 and 2010. It's been a decade since, it's been a very slow moving and largely led by only government infrastructure capex, if you ask me personally. But private sector capex has been sort of really very, very slow and very, very little. I think that can change in coming few years.
Okay. Okay. So let's try and focus on what I mean. The enabling factors for these. Now, do you reckon it's the? I mean, actually, multiple people say multiple things. Akash Prakash, in an article that he's written recently, also writes about how the interest from the global firms for an Indian partner or the China plus one partner alternative seems to be very strong. I was speaking to somebody who said that there's likely to be a manufacturing renaissance in the country over the course of the next 4 or 5 years. What are the building blocks? I mean, it can't surely be the government balance sheet, because we know that that may not be in ship shape with the tremendous amount of dole outs that the government has to do. So what are the building blocks for manufacturing to succeed, Anand? Why do you get this confidence that Indian firms will be able to set up capacities and there will be demand for all of those?
I think if you go back into the history and see what happened to manufacturing in this country, then you will realize, first we need to understand what was ailing manufacturing. And to be very honest, last couple of decades has been a decade where we have actually seen a downturn in manufacturing. And that reflects in our imports from China. So what was happening that the scale and the size of manufacturing in China made sure that they could sell a lot of stuff and to India very cheap. And if you would have seen from smallest thing like safety pins to the big things like furniture and lightings and whatnot, and to some extent chemicals and metals, everything in tires, I think we used to get from China. and that's not unique to India. It applied to US and Europe also. So there was overcapacity there, and that literally took a big toll on manufacturing sector in general and few sectors in particular. I think the turning point is coming where, and it's not recently. It's been almost going on for almost 5 6 years. But a couple of things have changed in China. One, obviously, uh, their demographics would not allow them to continue to expand manufacturing. The jobs, the salaries are increasing there rapidly. Obviously, they will also create jobs in the tertiary sector, which is the services sector, and to that extent, manufacturing will become more and more expensive there. But I think drastically, what has changed in 5 6 years is the focus on pollution, focus on pollution of land, water, air has been tremendous. And if you see, that has led to a lot of crackdown on quite a few manufacturing practices, which allowed them to be very very cost competitive and export to the rest of the world. So you can see what's happening in chemical sectors for last 5 6 years, because they had a massive crackdown in their chemicals industry 6 years back, and more recently that's happening in steel sector. I think the third element is obviously, which is more recent, is a lot of tariffs and non-tariff barriers which China itself is creating, or it's been created by rest of the world, because people are wanting to protect their own manufacturing. So you saw big 25% import tax on steel in China, and so much so in India also we are having quite a few of anti-dumping duties and others, where there is an unfair dumping, which is hurting the manufacturing sector in this country. So these are little external factors. More domestic factors, I think, continuous investments on infrastructure, even housing has been, notwithstanding, it's been a little soft in last 4 5 years, but that's also is a big driver of demand for manufacturing goods. So that's sort of picking up more recently. uh, uh, the government's infrastructure capex leads to demand for steel and cement and other allied materials. That also leads to, now if you see, the capacity utilization in manufacturing sector, especially in top 10 cement companies, steel companies, that's running in excess of 85%. So that would lead to a capex cycle, because now there is a need for capacity as India recovers from the pandemic. So as I said, there are multiple factors. China plus one, you already spoke about. The global uh, consumers, the global companies would want to de-risk from China alone, and that's been more recent because of the pandemic. It will only accelerate, while they were always thinking on that front, but it will only accelerate. So I'm seeing multiple factors coming together, but more importantly, the higher utilization in the manufacturing sector will also lead to a new capex cycle that will further drive the demand for goods and services.
So, from an investment perspective, Anand, are you saying that it's the normal cycle, and because numbers are skewed in favor, investors will make money because the numbers, any kind of growth will look exponential, so to say, on a very low base?
Yeah, obviously there will be operating leverage. We are already seeing in these results, the numbers that's been coming through for steel companies, cement companies. What has happened also, you have to understand, when I look at market, and people keep on talking about the richness and expensiveness of valuations, I divide the markets into three parts. One is the B2C businesses, the companies which are facing consumers. In between are these manufacturing companies which are B2B. There can always be overlap, that the manufacturer can also be the owner of consumer. And last is miners, the farmers. Somebody is mining iron ore, somebody is mining zinc ore, somebody is mining coal. And what has happened, a lot of wealth creation, lot of, and services of course, and lot of wealth creation and lot of expensive valuations that we are seeing is in that part of the economy, which is B2C, which was consumer, because they were benefiting from a very low inflation on manufacturing and mining, if you ask me. We didn't see much of an inflation in last decade, but they could pass on a higher price to their consumers, so their margins also expanded. What we are now seeing, and that is very important, that the valuations in the mining as well as in the manufacturing is not steep, bearing some of the sectors like chemicals, which have been in the bull market for last 3 4 years, I think the valuations are not very demanding. At the same time, I am seeing they have a pricing power today that they never had in the last decade. So you will have operating leverage, utilization going up, pricing power is with you, margins are looking up. On top of it, you can also have a volume growth as they embark upon capex. So all of a sudden, this sector, which was sort of low growth, low margin, looks like for next couple of years at least, and obviously that's the visibility we have. But we can have a volume growth rate, we can have margin expansion, and that makes this sector, given the valuations where they are, extremely attractive.
Yeah. And and the government support as well, Anand, because I think the environmental clearances have sped up. Uh, for example, in sugar, I saw UP giving a single window clearance to
Neeraj, I
ethanol
lost you.
plants as well. What are your views
Hello,
here? Anand, can you hear me? Anand, can you hear me?
Neeraj, I can't hear you. Sorry,
What about the government support?
no, I lost your voice.
Okay. Um, Let me try and repatch. I don't know if it's my internet or Anand's, but if we'll just try and get that back in a minute. Um, Anand, if you can hear me, what about the? Okay, I think we'll just try and get Anand Shah back on. Remember the two pillars of growth as we kind of try to uh, gather from him. One of them being manufacturing, and the other one being something that will serve as a cog in the wheel for successful manufacturing, and which is
Sorry, Neeraj, now I can hear you. I lost you in between completely. Now I
no
can
problem,
actually,
Anand.
yeah.
Okay, so I was asking you, what about the government policies? You think they are supportive enough? Because I see environmental clearance is sped up, so on and so forth.
No, I think indeed, and look, India has missed out on manufacturing. We moved from agriculture culture to directly to services, but this is a very very important element for job creation also. So from the very first day, Make in India had been there, but obviously it's taking a long time to really, and especially the capex cycle globally is also not very hot. So to that extent, it was very difficult in the environment when the capex cycle was not great to get in companies to come and invest into India. But I think that's changing. That's changing. On top of it, as I said, China plus one is helping further. PLI schemes would help to that extent. We have reduced corporate tax rates, but more importantly, we further reduced a lower tax rate for the new setups that we are creating. So I think all those are there to make India at a level playing field vis-a-vis rest of the world for somebody to invest. India has the market. India has the domestic market. So you have a captive consumer base also for somebody to set up a manufacturing unit here. And last but not the least, I think this time around, the regulators are quite active. If there is an dumping which is leading to short-term loss of profitability, or it's unfair to the Indian manufacturers, I think there also we have seen quite a lot of action and quite a lot of unfairness, which would harm the profitability of Indian domestic manufacturers, that been sort of curtailed. So all in all, I think government can do only so much, but I think we have seen good amount of, I would say, already reasons to believe that corporates who wants to invest in capacity. I think the elements are there in India at this point of time.
Got it. Anand, so if chemicals as a manufacturing theme are expensive, what do you guys at ICICI Prudential find favor with? What within manufacturing looks attractive enough? What themes within manufacturing look attractive? And then we'll move on to infrastructure.
I think there are very few to select at this point of time, and to be very honest, we generally look for global competitiveness in manufacturing. So you need to not only be competitive within India, but you need to be globally competitive also. And within that, quite a few sectors are there which have survived the onslaught as I say, of the Chinese manufacturing. So the metals, textiles, cement is obviously fairly insulated from the rest of the world. That continues to do well. In autos also, auto ends also, India is fairly strong. In engineering, we are reasonably good, not much, but that's also a space which is there. And I think the one which is emerging and we're becoming fairly strong there is chemicals. Apart from pharmaceuticals, we always had that sort of advantage versus the rest of the world. So I think quite a few sectors are already there. With PLI, we will be able to enter into segments of the market we are not there, the semiconductors, the white goods, and others. So I think we are keeping our minds and ears open. I think we are looking at opportunities across, but some of these sectors which I already spoke about, we already are globally competitive, and to that extent, it's very natural that these companies are doing extremely well on the back of global recovery as well as domestic recovery.
Yeah, I mean, things like textiles seem to have turned a new corner, right? With what the government focus and a bunch of things being done globally as well. The Xinjiang ban and the Pakistan GMP status being revoked, etc. Okay, Anand, the other factor would be whether solid infrastructure would be a precursor to manufacturing succeeding, because while you manufacture all that you do, things around would need to be competitive enough, power, roads, etc., and stuff like that. Long spoken about theme, multiple times we've seen focus on infrastructure. Somehow the businesses don't give returns. Why is it that you think that this time around could be different, if you think this time around would be different?
Indeed, I think you're damn right that manufacturers don't make that sort of ROEs which they can make in markets itself. So, obviously people would ask themselves that why should I be in manufacturing in the first place? I think that's why my take is the return on equities and the earnings in manufacturing really needs to go up enough before people will put up capex and people will put up capacities. Having said that, I think on the infrastructure front, we've been lot of businesses, if you are well aware, have their own captive power plants because uh, we are very uncompetitive when it comes to power. Uh, Outside that, I think investments on road have been incessant and fairly good enough. I think the game changer can be dedicated freight corridor. I think the Western dedicated freight corridor, we are almost there. Maybe sometime in September we will have one leg, starting, and maybe by end of next year we should have the entire Western dedicated freight corridor ready. So I think that can be really game changer. To give you an example, in India, 70% of freight moves on road and 30% which moves on rail. Ideally, it should be the other way around. And because the Indian goods actually move on the passenger railway lines, they do get a very little priority, and to that extent, the time it takes on rail is as good as actually at times even worse than the roads. I think that can change. So Western Dedicated Freight Corridor is the first step, if you ask me, which can connect the entire northern manufacturing belt to the western ports, starting with obviously the Mundra and the Pipavav, but eventually even the JNPT would get connected. So I think it indeed we are not there yet in terms of infrastructure, but that can change as we keep on investing on that.
We're still not out of COVID. And the chart that we were showing, we borrowed it from a Moody's note, Anand, which said that with the COVID resurgence around, and this was specifically with India, a lot of these projects, and they cite how toll roads and airports being the principal ones, but even port projects could have issues. So the renewable power projects, etc., are separate, but the others could have issues with the resurgence in COVID. Do you reckon um, these humps the companies would get over and the projects would get over them? Because I mean, all of these airports, for example, big nascent business, so to say, some of the others, etc., for the private sector. Do you think these humps will be crossed over easily, or is it a bit uncertain because COVID itself is a bit uncertain right now?
No, I think delays are there, and quite a few. Towards the end of the project, you need some engineers from Western world or Japan or somewhere. They need to come and do installation on the last moment, and that's been sort of delayed in quite a few projects that we have seen of. So you're right to the extent that COVID has delayed quite a few of these projects in the last 1 year. But nevertheless, I think if you see compared to the first wave, the second wave has been sort of far easier for manufacturing sector. It's been more difficult for household. Whereas if you see the first wave, it was difficult on the manufacturing and the businesses and easier on the household. That's not the case with the second wave. Uh, the second wave, the manufacturing has got a little less impacted. Nevertheless, we still see some challenges on the international travel, and to that extent, I think some of the projects are impacted. But otherwise, we see uh, a lot of projects are continuing even through the second wave, continue to deliver stuff where you don't really need uh, any foreign travels as far as that is concerned. So, to me, going forward, we will have some lockdowns here and there. There can be a week or 2 weeks of delay, but our expectation from wave three, if at all, is not that harsh for the business as a whole. Uh, the households, the businesses, the governments have realized to some extent, I believe we have realized how to deal with this. And to that extent, the impact on the business, on the projects would be far lesser than what it had in the first 2 weeks.
Uh, Anand, like I didn't get the last part of your answer, but let me just try and simplify this for myself and for the viewers. Uh, 10 years ago, infrastructure used to be roads and ancillaries. Now, infrastructure has some port companies, it has arguably the development of the airport companies. Infrastructure by itself has taken a bit of a turn in that while power may not do well, renewable power may do well. And then, of course, there are ancillaries. Where do you believe there is a longer term potential for wealth creation? Which themes? Because growth in companies itself might not be enough if the growth is not coming at a good ROE, as you said. So, where do you find favor within infrastructure?
So I think as far as wealth creation is concerned, obviously, you know, the services industry and those we already discussed, that's been well known. The IT services, the banking services continues to look good and it will continue to create wealth. But particularly talking about infrastructure, particularly talking about manufacturing, I think the most important element, as I envisaged before also, and I said that the global competitiveness is very important. We need to identify which are the manufacturing segments of the market where we have reasonable strength. To give you an example, today, if you talk of steel industry, we have one of the largest access to iron ore and reasonably cheaper than what China would get it. So good reserves of raw material. We have that competitiveness as far as manufacturing of steel is concerned, and that's somewhere we definitely believe we can really grow big, and whatever the space China is giving away by not exporting into the rest of the world, India can actually fill into that shoe. So I think that's one opportunity for us. Similarly, in textiles, we have good cotton, uh, relatively cheaper than the rest of the world. We have good, we're second largest in world in terms of cotton production. I think we can be competitive there, and we should be able to make the most of it. So generally, pharmaceuticals you can imagine, chemicals you can imagine. We have capabilities, chemistry, science, knowledge, uh, science professionals. So English speaking science professionals, which had helped IT sector also, would help the chemistry and chemical sector, pharma sector as well. So I think we as a fund house, we're continuously looking at which are the manufacturing or the infrastructure plays where India has or the company has a sustainable competitive advantage. That's very important for us to survive any downturn, survive any COVID related delays. So we keep on looking for businesses. We have right to win. They have sustainable competitive advantage, and to that extent, you have a sustainable higher margins and your ability to withstand any sort of downturns in the segment, in the sector, or in the economy for the short term.
Okay, and that can be probably applied to non-infrastructure and non-manufacturing themes in general as well. So lovely to end the conversation with that piece of insight. Anand, great having you. Second time that we've spoken to you, and we look forward to more. Thank you so much for your time today.
Thank you. Pleasure. Thank you for having me.
The pleasure was ours. Viewers, thanks for tuning into this edition of The Talking Point.